Breaking overnight, global markets are reacting to unprecedented geopolitical shocks. We're watching traditional finance and digital assets just collide in real time as international tensions reach an absolute boiling point.
A major development is completely reshaping the crypto landscape right now. Escalating US-Iran strikes, compounding with newly proposed trade tariffs targeting Europe, are triggering immediate severe reactions across literally every major trading desk in the world.
As institutions reposition, the digital asset market is facing another massive pivotal moment. We have just seen $875 million wiped out in an absolute flash. And this rapid contraction, it's accompanied by a staggering $7.7 billion stablecoin exit from the entire ecosystem. Bitcoin investors are watching this incredibly closely. The flagship asset is currently holding the line, hovering right around the $62,870 level amid all this mounting global chaos. The pressure is seriously on, and every single tick matters right now.
Welcome back to Daily Crypto, your trusted source for the biggest stories shaping Bitcoin, blockchain, AI, and the global financial markets. I'm thrilled to guide you through this explainer today. We're covering the developments that every crypto investor absolutely needs to be watching. We're going to break down exactly what happened, why it matters, and what could come next. Section 1. Global tensions shock markets. Let's examine how these compounding international crises are creating a massive pressure cooker for digital assets. We are witnessing a perfect storm of macroeconomic pressure points right now. The immediate market shock of military action, specifically the U.S. strikes on Iran, is colliding head-on with the economic uncertainty of proposed tariffs on Europe. Because of this, we're tracking a massive $7.7 billion stablecoin contraction, which is driven heavily by a $2.5 billion tether burn in Europe. I mean, when liquidity evaporates this fast alongside geopolitical conflict, you get the severe spot sell-offs that we're seeing today. So with all of this intense macro pressure squeezing the markets, it brings up a really crucial question. Is the regulatory environment shifting? Are Washington's latest legal maneuvers providing the clarity and relief these volatile markets desperately need to stabilize? Or, are they just adding to the bottleneck? Section 2. Regulation wins and delays. In Washington, the current landscape is one of stark contrasts.
On the positive side of the ledger, the SEC has officially dropped its enforcement case against Consensus regarding their MetaMask wallet. Guys, this is a monumental victory for the DeFi space. Why? Well, because the case was dismissed with 0 fines and absolutely no admissions of wrongdoing. For the thousands of developers building Web3 infrastructure and the millions of users relying on self-custodial software, this signals a massive sigh of relief. It really suggests that foundational wallet tools might finally be getting some breathing room from regulators. But on the other side of the equation, we have severe political roadblocks. While the proposed strategic Bitcoin reserve plan is highly ambitious, it's currently completely stalled by active infighting between the Treasury and Commerce departments. Our sources indicate that this bureaucratic clash is actively delaying the rollout of the crypto plan. It just goes to show us that integrating digital assets into traditional government frameworks is incredibly complex, and interdepartmental friction can bring even the most highly publicized initiatives to a grinding halt. Meanwhile, over on the legislative front, there's a very surprising shift taking place. The Clarity Act is gaining sudden, really unexpected momentum. The National Organization of Black Law Enforcement Executives, or NOBLE, has formally endorsed the bill, and the major county sheriffs have actually dropped their previous opposition to it. So the crucial point to take away here is that crypto-related legislation is starting to find powerful allies in law enforcement circles. Groups that previously viewed the industry with deep skepticism are now actually coming to the table. Section 3. Bitcoin miners pivot to AI. The very infrastructure that secures crypto networks is undergoing a fascinating transformation. We are witnessing an incredible identity shift in the mining sector. Look at Tariffs, for example. They're effectively abandoning their legacy as a traditional Bitcoin mining operation to become an AI landlord for Anthropic. They're transitioning from validating blocks to becoming a dominant data center provider. To truly grasp the magnitude of this pivot, just think about this number, $19 billion. That is the value of the lease TeraWulf signed with Anthropic for their data center in Kentucky. This fundamentally bridges the gap between heavy crypto infrastructure and the artificial intelligence boom. I mean, these mining facilities already possess the exact things AI companies are desperate for right now: massive power grids, advanced cooling systems, and sheer square footage. It's a complete evolution of the crypto business model that honestly nobody saw coming a few years ago.
Section 4, Solana's tokenized asset boom. While infrastructure pivots to AI, the software side of blockchain is finding its own institutional footing. A massive macro shift is taking place on-chain.
In the second quarter of 2026, Solana hit an explosive all-time high of $5.77 billion in tokenized asset volume. What you really should take away from this is that despite the global market chaos, serious, heavy-hitting capital is still flowing into tokenized equities and real-world assets. Institutions are actively leveraging high-speed, low-cost blockchains for tangible financial products, which proves that the underlying tech has immense real-world utility well beyond just speculation.
Section 5, the road ahead for crypto. So how are veteran analysts and legacy institutions reacting to this unprecedented blend of geopolitical stress and technological evolution?
Well, major legacy players are now issuing some pretty stark warnings. JP Morgan has released a striking analysis, directly calling out Michael Saylor's aggressive Bitcoin acquisition strategy as a systemic risk. Now, when one of the largest investment banks in the world flags a major corporate hoarding strategy as a potential vulnerability for the entire asset class, it's a huge signal that market psychology is shifting. It's a real reminder that extreme concentration of an asset carries its own unique, significant dangers.
Furthermore, that caution isn't just coming from the big banks. Legendary trader Peter Brandt is signaling extreme caution as well, indicating he might completely dump his Bitcoin holdings in favor of traditional gold. This perfectly captures the current market anxiety. When global tensions flare up like this, traders are forced to decide, do you trust the digital gold of Bitcoin or do you retreat to the millennial-old safety of physical gold?
And that leaves us with this final, provocative thought. In a market completely torn between massive AI infrastructure pivots, the explosion of tokenized assets on networks like Solana, and the very real pressures of global conflict and massive stablecoin exits, as institutions reposition, who will lead the next global rally?